Okay, gentlemen, we have the tall task of breaking down raising money for deals and how to do it, what we've learned. If it's all right, let's break it down this way. I'd love to talk about strategies around raising capital, maybe the ideas of what we've done and how we've learned around that. Maybe get into some of the risk and rewards, the legal part, the investor expectations. And then I think along the way, we're going to talk about lessons learned, but maybe if there's at the end, we could recap this for the person listening. So if they're taking notes, if this is something super interesting they want to do, maybe they'll have some good takeaways. So, Stallion, I'm coming to you first. I want to talk about strategies around raising capital. Right now, we're in the process of raising money for a debt fund that we have. And, this is a more traditional type investment that people would have outside of maybe doing individual one-off deals. Like we're raising, tens of millions of dollars as we're buying businesses. Talk a little bit around the strategies around that.
Well, I'll tell you, I don't pretend to be an expert in this space at all, but I can tell you that there's a couple different ways that I've learned are really kind of like how I would want to invest, right? So in the sense of giving people an overview, some way that they can kind of research on their own. Is this something I want to get involved with? So having the proper documentation that people can review, and then also giving them an overview in some form of like a webinar or elsewise, like giving them an opportunity to engage with that from a Q&A standpoint. And then secondly, I think the way in which people approach, if you go to somebody and you say, hey, I've got this debt fund, do you want to put money in it? It immediately elicits, just from a psychological standpoint, a wall. It's like, I'm not really interested, even if it was something I was interested in. And it's because we just naturally put those kind of walls up. But if you go to somebody and you say, hey, who do you know that may be interested in this sort of a debt structure that we're doing, raising money, it immediately makes that person start to think about other people, but also themselves. They don't have that same kind of wall put up. And so that's what I would say is, like, from a strategic standpoint, give people a lot of opportunity to engage with the topic, engage with the details of the deal. And secondly, don't make it you have to be the one to invest in this deal. Make it an open-ended type of opportunity, as people can be more open with the idea.
If you've listened to our show for any length of time, you've heard us talk about infinite banking and how we were able to use that concept to create over $50,000 a month in passive income. But it's just not that easy to figure out, how does this all connect into my own personal system?
Stallion, that's why we created the passive income operating system, bro. It shows you how to turn active income into passive income. It makes all the steps come together. If you would like to get access to it as a podcast listener, we've never given this away in public before. Go to what'swhatwallstreet.com/PIOS.
I think what you said there is that you have to relate to individuals, and that obviously clearly the person, if you're the kind of person that's going to be raising money for something like this, you're going to be dealing with people. So if you don't have that skill and that trait, you better start honing it, because it is a people business. People don't invest in deals, they invest in people. You and I, Joey, have invested in some deals that have gone bad, and it wasn't because we were super excited about the deal and that's the only reason we did it. We invested in the people, and just, there was some things that we didn't understand, that we weren't really invested in those people. We were investing in people that those people were invested in, and we may have not invested in those people. So the strategies of raising capital is dealing with people, getting on a one-on-one level and having conversations, because the reality is most people have money sitting somewhere that needs to be deployed, are looking for a place for it to go, whether it's coming out of their infinite banking systems or earmuffs everybody coming out of a qualified plan that they acquired over time. And now they're trying to figure out, what do I do? Maybe, emptying it out and dealing with the penalties, not what they want. And they're trying to figure out, where do I put it? And they're looking for opportunities. Coming to you, Jamie, tell me a little bit about maybe some strategies around raising capital that you've experienced personally.
Yeah, absolutely. I mean, we're talking about kind of raising money, how to do it. I'm assuming most people are trying to figure out how to get started, right? So I just will tell a story of how I got started, take it a little smaller scale. You're talking about raising tens of millions of dollars. My first deal, I raised $90,000, right? It was very similar to JD's deal. It was a single family home that I was fixing and flipping. And what I just started to do is I got some experience under my belt using bank money, using hard money, kind of the traditional channels, that I had a track record to go and talk with friends and family. And to Joey's point, it wasn't, hey, I've got this deal. Do you want to give me money for it? It was, I'm investing in real estate. Here's what I've done. Here's what I'm doing. Oh, and by the way, I give private lenders an opportunity to invest in my deals, pay them a great return. And people will raise their hand to self-qualify and say, oh yeah, tell me more about that. How does that look? What does that look like? And then you could just start the conversation, right? So that has evolved into a good network of starting with friends and family. Then word starts to get out to their connections. They know people who maybe have money sitting on the sidelines who would be interested in kind of a short-term, quick return of capital, cash flow play in the private lending space, the real estate at least. And I think that's where a lot of people I talk to are trying to get started with raising funds is, hey, I want to get into real estate. I know that I can only scale so fast with my money. How can I start to use other people's money to scale, right? And there's speed that goes along with that as well in scaling. And so that was a strategy that worked for me was, yes, it is a people business. People invest in people they know, like, and trust. And it's just presenting an opportunity through talking about your experience. And that was a big strategy that has worked really, really well from a small scale. And I've done that for 5-6 years now.
JD, in the intro, you talked about just some of the very first deal you got into, but it's kind of grown pretty significantly over the years. Talk a little bit about that.
When we first started, and we'll get into some of this from a learning lesson standpoint, I didn't know what I didn't know. And so I thought I had to give everything away, right? Like I had to give it away in order to attract people to want to invest with me, because I didn't realize what the alternative was. I think this is super important, is that you have to think of from the perspective of what's compared to what. Meaning if I'm asking you, Russ, to invest with me, it's compared to what? Meaning you're going to invest somewhere, you're already going to invest somewhere. Well, what's the alternative? If you don't invest there, why is mine better than what you're going to invest in? Right. So I think having that compared to what idea is really, really important and valuable. So we went from, raising 130,000 to now we've raised tens of millions of dollars, for the stuff that we're doing now. And we'll continue to keep growing and raising that over time. And I think what I've learned is, one, you have to know what it is that you're raising for. Like you really have to have a fundamental working knowledge of what you're raising for, whether as the operator or as the capital raiser. I think it's super, super important. Now, what's the difference, right? The capital raiser is just the person that's bringing the capital to the table. They're just going out raising the money, but they're not operating the deal. They're not the one that are actually executing the thesis or the business plan to make the deal come to fruition, right? Where that's the operator. The operator is the one that's actually doing all the feet on the boot work, if you will, the feet on the ground, those types of things. There are some shops out there that are vertically integrated. They're raising the capital and they're the operators, right? We do that. And there's others that are out there that are just raising capital. And there's nothing wrong with that. But I think it's super important that you know who you're dealing with, and that if you are the one that's raising the capital, that you really have a fundamental understanding of what the business plan is and what the thesis is, what could go wrong, right? What could go well, and one of the things that Russ, you always ask is, how do I lose all my money, right? Because you want to mitigate risk as much as possible. And you talked about this earlier on, like when you start stewarding people's money, that's a big responsibility. Like you're not just raising money to just make money, right? You are raising money to steward somebody else's resources that they worked really hard for. That's a really, really big responsibility. I don't think a lot of people put enough emphasis on that notion that you are stewarding people's resources.
Well, I think too that, whether or not you're deciding for yourself where you are in your journey. And if you just started out, maybe you just set up your passive income operating system, you've got some capital now growing inside your insurance contracts, and you're trying to determine, do I buy assets or do I reduce debts to minimize my monthly expenses? You're borrowing money from the insurance company, right? And in essence, raising money for the deals that you're doing. And I think if we take this like micro approach to managing that money, even when it's our, quote unquote ours, but it's coming from the insurance company, and we apply that on a larger scale, it will help us become better investors. Let's talk about the risk and the rewards, because I do think there's things that we have to understand as we invest and we borrow money. What are some of those risks and the possible rewards, Diane?
So this makes me think about the idea of, like, as you and I have been raising money in this debt fund, we are very clear to say, like, over the years, people have wanted to invest with us. Like, they see our passive income report and they're like, hey, you guys are doing some good things. I want to kind of just give you money and then let's do something at a bigger scale. And the reasons that we didn't were for the reasons that I'll outline now as far as the risks. You and I didn't want to put someone else's money at risk with an operator that was outside of us, right? Someone who we can't control. We can learn their business model, but we don't know it 100%. We don't know all the variables that could be at play in that deal 3 years from now, 5 years from now. We don't know. And so we're just like, nah, that's not a good fit. But whenever you can be as close to the deal as possible, which is why now we're doing this debt fund, because it's investing in our business that we do operate on a daily basis. We do have the track record of how our cash flows have grown, 20% every year. And we can point to that and say, hey, this is how we're going to pay you back. And this is what we're doing to expand. All of a sudden, those risks are mitigated. Those risks are way, way lower. And so it makes it like a no-brainer. So that to me is, and just to, again, piggyback on what JD was just talking about, is operators and capital raisers. There's very, very, very different. And just because you like one of them doesn't mean you're going to put money with that person, because you got to like both. You got to really feel 100% committed to both.
Well, I think part of the risk and reward here is that if you're getting into a business partnership or you're getting into an investment partnership, you need to understand the traits and characteristics of the people you're investing with or getting in partnership with. Joey, you and I, we follow a tool called the Culture Index. We've had Matt White on our show in the past where he talks about, not investing in people through gut, but through analytics. We know that, it's just not a line. It is the truth. When I talk in our intro that the, lack of follow through guy is not nearly as interesting as idea guy. Well, Stallion's lack of follow through is almost as bad as mine. So we definitely
Facts.
would not want to invest in an operator with someone else's money, because we're just probably not going to follow through and look through all the details for that specific person. If we didn't have an investment operator, right, that would do that due diligence on our behalf, there's the risk. If you have that trait and that's who you are, using other people's money and investing in deals that are maybe not yours, like you were talking about, JD, you're just being a capital raiser, maybe the risk are minimized because you do possess that follow-through trait. You do possess that just always looking for, under every single corner and asking those critical questions that will reveal whether or not the deal is a good deal or not. What else would you add to this conversation, Jamie, around risk and reward?
Yeah, you hit on some great points. I mean, when I think about, especially just taking it back to what I know very well, raising money for kind of single family homes, expanding into doing some private lending deals where we're bringing in other people's money. The big risk, right, is back to JD's original point, is like, I am a steward now of somebody else's resources. I feel personally responsible for that deal performing like it should, right? I take that on. I personally carry that. And so a risk in my mind is, could there be potentially something that goes wrong? And I'm big on relationships. I'm big on just having a community. And so it scares me, to be totally frank with you guys, to potentially ruin a relationship over an investment deal, right? So back to the point of making sure you absolutely know what you're investing in is so important. Having control over that, I love that as well. How are you operating, or how well do you know or can control the operations, is super important. From a reward standpoint, it's flip side. I get to bring other people along with me. I get to potentially change someone's mindset, change someone's perspective on life, potentially change their financial future and help them control their financial future, right? That's so big for me when I see other people. There's risk and rewards and everything. Think about what most people are doing. Most people are sending money to the stock market before they ever see it hit their bank account, and they're praying that it's there when they retire, right? And to me, that is a broken system. And so I want to help people take control of their lives, and I feel like that is the biggest reward that I can get from bringing people along with me, is helping people take those maybe first steps into a quote unquote alternative investment, but be able to guide them with my experience and my expertise and knowledge.
Well, here's just a personal example. Like my father-in-law in 2006 and 2007, whenever the market was starting to crash, and as an investment advisor, I'd put these stop losses on his stock and it went to cash. He and I both were terrified of what was going to happen in the market going forward. And so he was just like, what do I do? And we used the becoming your own banker strategy that we learned about a year later to actually lend money to my wife's dental practice, take over the bank loan, and have her start paying him whatever $7,000-8,000 a month back. Well, that created this mindset of he and I talking about investing together. And there's been a lot of projects that he and I have done together. In essence, I was raising money from him and investing in projects. And as I sit here today, we're 15 years after whenever all that started, and a lot of things are going on health-wise in their family. And this has been like the question that always came up in his mind is, will I ever run out of money? And I can look back over the last 15 years in this pot of money that he's been able to build because we were investing in deals together, doing opportunities that he would have never been involved in, especially given the hesitancy of the market. It's like, man, that's cool. That reward of being able to bring him along and to have him as confident. And he's like, this debt fund, he's like, okay, when are we investing? Put me down, like he's excited because he's seen what it's done in his life. So that's huge reward that I have personally. JD, speaking to the risk and reward of doing deals and raising money with others.
Yeah, I think from a risk standpoint, it's important to understand what type of experience does the capital raiser have with the investment, right? Like, I think that's important to note. Meaning, is this somebody that's just the first time capital raising, but they've never done this type of deal before, right? Like I mentioned before, how close are they to the actual investment themselves? Because sometimes you can have folks that are 2 or 3 or 4 layers removed from the actual deal itself, and that can become pretty dangerous because there's folks out there that just chase acquisition fees, or they chase management fees, meaning they're just out raising money to get paid, and then that's it. They don't want anything else to do with the deal. Now, again, I'm not saying that's everyone, right? Please don't hear me. But in terms of just talking about risk, like these are risks that we should consider to know what kind of goes on in this alternative investment space. And so I think those are super important because I want to be as close to the operator as possible, if not the operator myself, right? And so, for example, when it came to raising money for fix and flips, I was actively doing it, right? So I could control it. Right. When it came to raising money for land, we had already done land deals. Right. So like I had experience doing it with my own money. Right. So like the things that we've raised money for have been things that we're either actively doing ourselves or we have experience in doing ourselves. And so I think that's really, really, really important. And there's some really good folks out there that raise capital that have done hundreds of millions of dollars of deals in their particular space. From a reward standpoint, I will tell you there is something that is, I don't know if there's anything more rewarding than having investors tell you, thank you for doing what you said you were going to do, right? I literally had a call yesterday with an investor. We were chatting about this new opportunity that we have. And he was like, man, I just want you guys to know that y'all are the only group that has actually done what you said you're going to do. He's like, we put money in this place, we put money in this place, but y'all are the only ones that have actually delivered. You're the only ones that have actually reached out. Like, you guys have done everything you said you were going to do. And that was just super rewarding for me. Right? To know that they were pleased and happy and wanted to keep investing with me because of the experience that they had. And I think that's so rewarding. Again, going back to stewardship, if you think about the parable of the talents, right? Or and like if when the steward comes back to ask you how well you did to steward their money, you want to be able to say, hey, I took your 5 talents and I turned it into 10 talents. You know what I'm saying? And they say, well done, good and faithful servant. Like, to me, that's the joy and the reward of what it is that we're doing, is we're going out to help people turn their money into more money. And I think that is so rewarding.
There was nothing worse than walking into class when you're in school and the teacher saying, pop quiz day. Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
That's a great transition point to the next point we have, Stallion, which is investor expectations. How do you manage those? And one, when things go well, great. But how do you also manage the downside? Because things don't always happen the way that we all planned it.
Well, we've been on both sides of that conversation when it comes to things going as planned and things not going as planned. And I think it kind of varies depending on the actual deal, because there's some deals that are just so plain Jane and simple. Like from our debt fund standpoint, it's just simple interest. It's just a boring paid monthly interest only type of opportunity based on something that we know very well and has been super consistent. But there are other deals that have a lot more variables at play, and you know that going into them. And so, in my opinion, those require a lot more communication from the actual operator to know what's going on. I mean, to be honest, there's some of these deals that we've been involved in that are just a mystery, right? Because they don't communicate and their updates are very rare. And it's kind of one of those things. It just doesn't really lead you to say, man, I want to do more of that. Versus on the other side, I just found myself recently getting an update from a multifamily operator that we've invested with. And I was like, man, this is so good. Like, this is so well written and explains all the things I need without getting into like the most granular detail that I probably wouldn't understand anyway. And so it's just like, man, I really appreciate that because it shows me like, this is how I'm stewarding your money. To you guys' point, this is how we're stewarding your money. This is how we're on plan or off plan. And by the way, I'm okay if it's not perfectly on plan because that's just a projection to begin with. But let me understand why. If I don't understand why, then there's lack of trust. There's lack of like, hey, I don't think this is something I want to continue to do.
Well, you even shared with me a second ago before we press record how an investor was asking you, hey, should I invest in this debt fund? And you knew that investor's profile was very excitable, right? Let's just say Jamie and me kind of profile. And you're like, I just don't think this is going to be a good deal for you. Not that it's not going to pay off. It's just not going to be this, like, you're not going to have these like huge swings. All it's going to be is consistent income every single month. It's going to be boring. In the end, you're going to get all your principal back. You're not going to get like 5 times your principal back. Like there's no opportunity, for you to like quadruple it. It's just a consistent return. I think setting those expectations are good.
Sure.
But the opposite too is you mentioned this, and I remember the first thing I raised money for, it was a very complex deal. It was actually in the life settlement space where we were buying insurance contracts from like people that were in their 80s and 90s who no longer wanted them, right? But didn't want to turn them in just for the cash value. They actually wanted to sell their death benefit to a pool of people. And I was in a pool of people that were buying them. And I just knew that the investors that were coming in that deal with me, they understood nothing of it. I understood it because of our, experience in the insurance world. But just the complexity to constantly keep them up to date on it, right? Like there's just nuance to what's happening with the maturity dates of where it was expected and now how those have adjusted and now, the payout of that. And, oh, by the way, we had to keep this amount of reserve. So even when there was certain maturities, hey, we didn't get to get all that much, that cash, we had to go back and build up our reserves. That means we'll get that in the end, assuming it all, like there's just a lot that goes on there. And when you have a low details profile like myself, you just want to share the high level stuff. It's like, man, that's just one of those deals I shouldn't have raised money for because it creates a need for me to follow through at a higher level than I have. And they didn't have a platform. The deal didn't have a good platform for me to use to communicate other than just email. Well, now as we're building out this investor debt fund, we went and then went overboard, right? Like we invested in technology that keeps it all there. You go there, you have your own investor portal, you log in, you see exactly what your deal is, you see exactly when your payout is. Like, here's all the details of what it is. It's very simple, but it's there for you. If you ever have a question, just go there. I love that. Like that makes our profile, like the follow through, very simple. We don't have to worry about it. It's already done. All right, Jamie, what about for you? How do you manage investor expectations?
No, great question. I want to jump back to risk real quick because I think we'd be remiss if we didn't talk a little bit about understanding the legal risk, right? I think we kind of missed over that, right? But as we're out raising money for deals, you need to understand how to do this legally, right? And so we're all talking about different types of raising capital, and it's super important. I just want to hit that before we move on, to understand what you need to do legally to go raise money, right? Don't want to tell you just to go out there and start calling family to friend and try to pile money to invest a deal. That's probably not a good idea, right? But that goes into expectations, I think, a little bit, right? Setting expectations with the investors is super important. If you are out raising money, let's say that it's a security, it has to be registered with Edgar, the SEC. Do you have to be an accredited investor? Can it be a non-accredited investor? What is that? Explaining that to those investors, right? Making sure they understand what they have to do to be able to participate in that deal and what to expect out of the deal, right? When I think about raising money kind of in my world for mainly private homes, it's very trying to set those clear expectations up front of how you're going to receive payment, what that interest rate is going to be, what the time frame of the project looks like, what you want from a communication standpoint. This goes into lessons learned. Not all money that wants to invest with you is a good relationship. If I got someone blowing me up every 2 weeks on a fix and flip asking me what's going on with the deal, that's probably going to frustrate the heck out of me, and not be a good relationship, right? Because that is a process. It takes several months for that to go on. So, I mean, from a setting expectations standpoint, I think disappointment is just unmet expectations. And so we have to get very clear on what expectations are and be on the same page before we ever make a business arrangement to go and work together.
Yeah. Well, I wasn't skipping over legal, by the way, Jamie. I was waiting till lessons learned.
Going, my bad. It just jumped in my head. I was like, we got to put on this.
I'm not kidding. I'm 100% certain. But yes, it's possible. Thank you for bringing it up because I don't think we could talk about the legal part enough. We probably don't have enough time nor the capability, but there are some points that can be made. John David.
Yeah, this one's, I think, super important because if you've ever seen a pro forma or a pitch deck, I'm sure you've never seen a bad one, right? They are all really, really, really good. All of them look good if everything goes perfect. But what if they don't, right? And so it's important that you manage those expectations and don't just talk about the good things, but you also talk about, well, let's talk about what might go wrong. And if it does go wrong, how did we underwrite the deal? And so I'll give you an example. When we underwrite a deal, we underwrite it to the worst case scenario. Like we want to understand if this deal has to go terribly bad, are we still going to be able to get investor capital back to them? Are we still going to be able to return principal back to them? We ascribe to Warren Buffett's investing rules. Rule number 1 is don't lose money. Rule number 2 is see rule number 1, right? So like, we never want to get into a deal where we're chasing because there's always another deal, always another deal. And if you think the one that you're about to get into is the only one that's going to be a grand slam, you're wrong because there's always going to be another deal behind this one. And I think it's super important that things don't get pitched from that perspective that, hey, this is like a once in a lifetime opportunity. You got to get in, those are, that's from my perspective, that's a language that you need to be careful with when the person is pitching the deal to you, right? Because they're not effectively managing your expectations because now you're thinking this joker is going to be a grand slam. And when it's not, you are going to be really, really, really disappointed. And so I think it's important to understand, again, what could go wrong as well as what could go right. And how did you guys underwrite the deal, right? If all things go really, really badly, would we still be able to get our money back, right? Or would it be tied up for a long period of time? Or would you do a capital call, right? Which a capital call means, and this has happened quite a bit in multifamily when interest rates went up, is the cost of the debt became too expensive. And so in order to start servicing that debt, they had to do a capital call to their investors to put more money into the deal to keep the deal going. Right? You want to manage expectations to investors of what could go wrong so that they understand if that event does happen, they're like, oh, they told me this might happen. And I'm grateful that they were honest about that this could happen. I don't like that it happened, but at least I knew it was a possibility.
Yeah, that was so good. All right, let's wrap this up. I know this has been maybe a longer podcast. Hopefully, if you're interested in being an investor, and raising capital for deals, or you're just trying to learn as an investor when you're investing in deals, what are the things you should be learning from? Hopefully all these things are helpful to you. Let's keep on adding to that lessons learned category, Stallion. What's one that you haven't shared so far that you would right here?
Well, first of all, let me just in light of what you just said, Russ, if you are at the beginning stages and you haven't set up your own passive income operating system, this is literally the genesis of all of us on this call, right? Without this, you really don't have even the framework to begin to even start thinking about being a better investor and then subsequently raising capital. So go to wealthwithoutwallstreet.com/PIOS and download our free ebook, and then call one of these coaches to get set up on getting that for your own self, for your own family. You owe it to yourself, and it literally will force you to become a better investor. As far as learning lessons learned, I've already shared quite a bit in terms of just what I've learned from this side of the coin, which I'm now applying on being an actual capital raiser for our debt fund. But I think the one thing that maybe we haven't addressed is, man, when things go wrong, be like, step up your game. Like you've heard us actually recently on our passive income report talk about an ATM fund that we were involved in, and there's been some things that have gone way wrong on that. And I'll tell you, the people that are involved in that have stepped up their communication, and in my opinion, have done an excellent job of taking a bad situation and making the people involved, like, that they care based on the way that they're communicating. And so, and again, there's a lot more lessons than that, but just in light of recent events, that to me is a real lesson to take away.
Yeah. Here's a lesson I had. We go back to the legal part, JD, is don't take somebody's word for it unless that person is a securities attorney when it comes to what is legal and what's not. And your state probably has different rules than maybe other states. And especially if you live in the state of Alabama, there's things that even the federal laws do not completely apply in the state of Alabama. I didn't know some of that. I took the word of someone from a stage that what I was doing was not breaking a law, and that was incorrect. I did break that law. I paid for that, and a lot of time, a lot of effort and money to fix the, crossing over that boundary. I take full ownership that I made that mistake unknowingly, but ignorance was not an excuse to get out of breaking the law. So make sure you go and talk to securities attorneys. As we were building out this investment fund, we spent a good amount of money in the due diligence process. And we've asked multiple questions to make sure, how does it apply not only to federal law, but how does it apply in our state of Alabama? How does it apply to others? And there's a lot of criteria that goes into that, and making sure that when you get on to calls and you start talking about stuff, you have the legal disclaimers there, that you've made sure that once those people do invest in your fund, there's probably laws that require you to register certain things in those states. Make sure you know what all of those things are. Don't skimp on the legal part and cost yourself way, 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 way more money than you ever can make on the deal. Make sure, and that maybe kills the deal for you. Maybe you don't end up raising money for it because after paying all the legal, it doesn't make sense to do it. That's okay. That's a good lesson to learn. Jamie, what would you say and add to this lesson learned stage?
Yeah, I mean, a lot of great points throughout this whole podcast. I'll make this short, but my big ones are: raising money is another investment, right? You need an investment of time, an investment of education, understand how to do it properly, right? And understand how to do it in general. That's why you're listening to this podcast. That's a great first step. So understanding what raising money is, what it looks like, what it needs to look like. Never forget that you're presenting an opportunity, especially when I think about like real estate. I'm presenting an opportunity to somebody. I feel like a lot of real estate investors go out and look for money, right? I'm presenting opportunities, not looking for money. So I think if you change that mindset, it just helps with the process of raising capital, right? You're able to present an opportunity, you fulfill that commitment, and then you build a good relationship with people. And back to what I said kind of in the last section is just, not every dollar that wants to come into your deal is a good dollar, right? And just know that difference. It can be difficult to turn people away early on or potentially look a different direction, but it will save a lot of headache as that deal progresses.
So good. John David, bring us home here.
Yeah, I mean, I've learned a lot from raising capital, from, thinking that I had to give equity away in the beginning in order to get people to want to invest with me. That's how I was able to raise that $135,000. Is the person that got involved was like, well, I want half of the company. And I was new, I was green, I didn't know, I was wet behind the ears. And I'm like, okay, great, let's do this, because I'm thinking that's going to get us access to like even more capital. We're going to be able to scale. And that's not what happened. right? And so I think it's important that, depending on the context of what you're raising for, whether it's for a syndication or for something like flipping houses, that you don't give it all away, but it's okay to pay more. Like there's nothing wrong with that, right? It's okay to pay more to get people really excited. Just remember that it's generally pretty hard to put the toothpaste back in the tube once you let it out. And so have confidence in what you're raising for. Certainly have confidence, but don't mislead people. Tell them the truth. People will respect you a lot more for being honest and forthcoming for what it is that you're wanting to raise that money for, and that you need access to their capital for. So learned a ton from raising that first time to now raising $1 million checks and things like that. Like it's been a wild ride. But if this is something you are going to get involved in, you gotta be diligent and stay focused, and just keep putting one foot in front of the other. Just keep putting one foot in front of the other, and good things will happen over time.
Yeah. I think if you're going to keep leveling up, if you ever met with our coaches, you've gone through our process, we have a thing called the right next thing. And when it comes to passive income, one of those superpower criteria is that you are using others' money to help you level up. Because I do think that there's a limit to how much money we will have, no matter if you're Brewster here, Joey, go back to my initial intro idea, and you got 300 million.
Yeah.
I mean, at some point, there's a limit to how much money you have, and if you're going to keep growing and expanding, and this is the talent that God's given you, like we're to use these talents to the highest level, right? And what are we using these dollars for? Not necessarily just for us to store up more money for ourselves, but maybe it's to expand His kingdom. Maybe it's to help others in different ways. Man, like in that process, you're going to keep growing. And so I think that you probably, if you're going to hit that superpower level, you may be that person raising money for it. So hopefully this was valuable to you. If it was, take time to like and rate, review the show, share it with us so that we know we can make more content just like this for you. Coaches, Stallion, thank you for being on. Everybody else, have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand, so that your wealth will never run dry. See you next episode.